Hi, my name is Mark Ashworth
I'm Neil Harding.
and welcome to Property Insight. Today we're going to be talking about how much money you need to buy an investment property, typically funded with a mortgage. So with a mortgage typically which is a buy-to-let product. So Neil, let's have a chat through the process of buying with a mortgage. So we found our property and we need to finance it. So we've obviously got a deposit. So what are the next steps?
So once you've had an offer made, accepted, and you're looking to apply for the mortgage product, typically with a bank, buy-to-let product, you'll have already had your broker lined up, and ideally an agreement in principle, which is basically a very preliminary assessment from the lender to say that yes, that we will lend. That's not an offer, but then you need to speak to your broker again at that point and start the process of applying for an actual mortgage with a bank, and your broker will help you a lot with that and go through what's out in the market. And the first things you really need to be thinking about are top level decisions around what sort of mortgage product do you actually want. So loan to value is an important decision to make. So there are some products out there that might be as high as 80% loan to value. Typically 75% loan to value is where a lot of people apply for a mortgage. Tend to get a better interest rate, so they tend to be a bit more affordable due to the lower risk for the bank because of the 75%. Also, do you want an interest or repayment type of mortgage? And I think most investors would go for an interest. I've always gone for an interest only mortgage product.
And does that mean that essentially with interest only, there's like you still obviously owe the same amount of money at the end of the term, but because you're only paying the interest, you're getting a better cash flow or better. You're only paying the interest, so there's more monthly. More left over at the end of the month, let's say.
Good question. That's right. It is. I mean, I think the interest only ones I think are better for a number of reasons. You do optimize your cash flow every month because you're only paying the interest. You're not paying any of the capital off every month. So yes, at the end of the mortgage term, you still owe the loan balance. And we'll do a separate video, I think, on the power of leverage and inflation and how that can really erode away the value of that debt over a period of many years for a long-term investment, which is the power of investing and using leverage. I would say, generally speaking, if you've decided you want to buy with a mortgage, and we typically would say you probably want to, as an investor, go for an interest only, probably 75% loan to value.
So let's say I'm already a homeowner. I mean, normally I think if I would have gone and bought my home, it would have been at 90%. So you're saying that I need a bigger deposit, and I guess that's because of the bank's attitude to risk, and they have a kind of they have to protect their interest, I guess, so they want to lend you less money because it's an investment basis. But obviously, if I've already got a mortgage, I'm probably already credit worthy. But if I don't have a mortgage of my own, I mean, is that going to affect my ability to borrow?
Yeah, it's a good question. I think a lot of mortgage brokers will probably tell you that if you already own your own home, then for one thing, you've got a better credit history or more of a credit history, and also you've probably got more mortgage products out there as well that are available to you. So I think one of the things that some lenders are concerned about is if you don't already own your own home and your first property is an investment property, then they might be a little bit worried that actually what you're sort of secretly trying to do is buy a property and live in it yourself for whatever reasons that you might have, and not really do what you're saying you're going to do with it. And then generally just making sure that your credit score and creditworthiness is sort of almost wrapped in cotton wool, really, I think is just a really good idea. As a property investor, you're probably going to be using finance multiple times throughout your investing journey. So if you have a terrible credit score, that's going to make life really difficult for you. So use things like Experian reports and credit reports to make sure that you regularly check what your credit score is.
Yeah, so check that out, improve it first. Let's say if it isn't good, but I guess you would have that conversation with a mortgage broker, and they would give you some advice as to whether you're in a position to be able to borrow by having a mortgage in principle. So they would assess your ability to borrow at the early stages, and also your ability to borrow with those certain lenders who would lend to you, and also on that particular property. So okay, cool. So if you're going to use a mortgage broker, then surely, I mean, how do they get paid? Is that going to come out of my pocket?
Mortgage brokers get paid, I think nearly in all cases from the lender. They will
like a commission.
have a commission, a fee that they will earn. And that level of fee, I think, changes depending on the product and the lender. On top of that, they may or may not charge you as an applicant as well. So some don't charge anything, some charge. Some, I think your broker charges a fee for each application. Some brokers also charge like a lifetime application fee to be sort of a member almost of their their service. But I think ultimately, if you're happy with the service you're getting, then it's fine. But just be aware that if you are paying as well, then the broker's probably getting paid twice, once from you and one from the lender as well.
So I guess, I mean, obviously certain brokers are going to, if they specialise, and if you're, let's say, finding it difficult to borrow, then it might be a good idea to pay someone who can actually find you, the right product, right product to have. So let's say I'm in a situation where I've got my own home and I've used a mortgage broker that was recommended to me by my estate agent, and they sorted my mortgage out. Would you go back to them, or?
Well, possibly. I think if a mortgage broker has been recommended by an estate agent, then the likelihood is they're probably earning a fee off the back end of that in some kind of referral bonus or something. That may be a good thing for you as well. It may definitely a good thing for the estate agent, I suppose. They're earning as much money as they can. They're not necessarily going to provide the best service, and it might not necessarily want to be your broker of choice going forward. But ultimately, keeping estate agents happy is not necessarily a bad thing.
No.
To do good deals and good business in the future.
But would you would you say that it would be a good idea to perhaps use somebody who specialised in the buy-to-let market as opposed to perhaps the residential market? Is there a difference between those types of mortgage broker? Because when people say mortgage broker, they kind of consider that they would know everything and anything about mortgages, whereas actually that's a very broad subject, isn't it?
Right. Yeah, that's a really good point. I think buy-to-let mortgage brokers with experience of that market are preferable. And ideally a broker that's actually invested themselves, because then you can really have a really good conversation with them. They know exactly what's important to you. I think the broker that you use is also a buy-to-let investor, so you can have a really proper conversation with talking about affordability when you're having that conversation that really makes sense. They know what you're after, they know what's important.
And I think certainly in my experience, I found that if you residential mortgage brokers do tend to be solely paid by their commission, and buy-to-let mortgage brokers tend to be paid a combination. I think it's a bit more intricate in terms of buying property for investment than it is for buying in your own home. I think lenders have a different attitude to risk on it, and also the actual lending panel, the lenders themselves, are usually very different, or they have different arms. So I believe it's the Nationwide Bank, massive lender in the UK. They don't lend on buy-to-let, but their sister company, which is the Mortgage Works, I think, is their marketing arm for property investment. But you wouldn't know that until you start buying properties.
True.
You think, who the hell are the Mortgage Works? Well, the Mortgage Works are, literally just is that company that deals with investment properties on a nationwide basis. So I think that covers. Is there anything else you want to talk about on mortgages on this video?
Perhaps just some other fees as well, which perhaps some people don't necessarily or aren't quite expecting, especially if it's the first time you've applied for a buy-to-let mortgage product. So just to go through some of those other fees, which perhaps are a little bit more unusual or specific to a buy-to-let. So typically, more often than not, when you apply for the mortgage, you'll have an application fee, which will probably cover the valuation. Some do come with a free valuation, but it's quite rare. And so you probably have to pay out of your pocket straight away, something between 200, 300, 400 pounds, something like that for a valuation fee. And that's payable up front. Then you've got to consider, are you buying in a limited company or are you buying in your own name? If you're buying in a limited company, most lenders that I know, and in fact I think every single one that I've bought in a limited company, needs a personal guarantee. The lender insists on a personal guarantee.
Same experience.
Yeah, it's very common nowadays. And so with that personal guarantee, the lender will also insist that you've taken independent legal advice. That needs to be someone different to your conveyancing solicitor, and you're going to have to pay for that. So they will insist that you do that, and you'll have to pick up the bill. So that could be anything from, at the more affordable end, maybe £200 or £300. That might be per director. It might be £500. But that's something that you'll have to pay for. And then the other big one, I think, is the product fee, right?
Yeah.
Which is 2%, 3% of the amount you're borrowing. It could be a flat rate, it could be £2,000, it could be £3,000, but quite often it's 2% or 3%, which can sometimes work out at 2 or 3K, even more. And I think that the thing that to remember on that is you've got an option typically. Most mortgage products, you can either pay that straight away or you can add it to the balance of what you're borrowing. And if you add it to the balance of your mortgage, then you're paying interest on that because what you've borrowed increases. And that's especially important to remember if you're remortgaging actually. And the other thing to remember, I think, with product fees, which a lot of people I think sometimes forget if you add it to the loan balance, is that it is still an expense. If you've got a £3,000 product fee, for example, on a remortgage, or even on a purchase, then that is a deductible expense. I'm going to turn my accountant hat on for a moment, but that is a tax deductible expense. And I think a lot of people just almost forget the accounting completely because they don't see the cost because it's just all
certainly needs to go in the right column.
Yeah, absolutely. Yeah. So it's a big expense. Don't ignore it.
Yeah, cool. So I think that wraps up the sort of basic idea around mortgaging and buying a property with a mortgage, which, as you say, most investors do. So thanks very much. I hope it's been insightful, and we'll see you on the next one.
Thanks.